Hey, my name's James Dixon. Welcome to my YouTube channel. This channel is all about investing in property, growing a portfolio, and I want to invite you along on that journey with me. I'm building a portfolio for my two girls, Georgia and Amelie. We've got them some deals already, which you can check out on this channel. So while you're here, two things I'd like to ask. Smash that subscribe button first. That helps me with the YouTube algorithm. It won't kill you. Smash me. It costs nothing to do that. And then hit the subscribe button and hit the bell notification. We've got new content every single day, which I think is the only channel that does that. So make sure you stick around. So I want to talk today about, are interest-only mortgages risky? You see, when I invest, we use interest-only mortgages, and so do 99% of buy-to-let investors. So what that means is when you take a mortgage, two options here. And so there's two types of mortgage. There's an interest-only mortgage or there's a repayment mortgage. And so on your residential property, maybe you own a house already, you buy the property and then over time you're paying down the debt. So at the end of the mortgage, in 25 years it should be, you will then owe nothing, right? And so you'll buy the property, let's just say it's 100K that you owe. This is 25 years. You'll owe 100K up here, and then over time, it's going to get less and less and less and less. Right? So eventually you'll own nothing. So the asset will be paid off. And that's because you will stop working at some point, and then you will need a pension, and your income generally drops drastically when you retire. And so this is how this works. Now, on a buy-to-let, the most common thing that happens is you borrow 100K here, and in 25 years, how much do you owe? Well, because you're only actually paying interest only, you still owe £100,000. Now, this worries some people because people have the perception that the right thing to do is to be mortgage free. But mortgage debt is the cheapest, most leveraged debt you can ever get. And it's actually some of the safest money that's out there. Now, you've got to be careful. And what actually happens is the bank do most of the due diligence for you. They're actually going to inspect the property for you to check that it's good. They're going to check the market and see whether you think you can get the rent that you actually say you can when you apply for the mortgage. They do all the due diligence because at the end of the day, it's their money that's on the line. So why do we need to worry, or do we not need to worry about interest-only mortgages? Well, for some people, they're obviously concerned that in 25 years, maybe they're retired at that point, they're still owing £100,000. But the difference is, on this one, you're paying the payments, right? It's your responsibility. Every single month, out of your paycheck, on your residential house, you're paying those payments off each and every month. On this one, it's your tenant that's paying that property down. They're the ones paying those bills for you. And so let's just think about it. In 25 years, is it likely that the house is worth more money? Yes, right? You can comment below if you want to on that one. It's likely that the house is worth more money, right? And so what normally happens to houses is house prices double every 10 years. So it's going to be 100 grand, then it's going to be 200 grand in 10 years, then it's going to be 300 grand. So it's going to be worth at least, that's 10 years, that's 20 years. It's going to be worth at least £300,000 if figures go like they have done historically. Now, is this data accurate? Well, since 1066, since records began, house prices have doubled every 10 years. So here's the problem. Your house is now going to be worth more than 300 grand, maybe 350, or maybe closer to, because in 30 years, it's going to be worth 600. So possibly this is going to be worth 400, 500 grand. So let's look at this. You've got the 100 grand debt that you owe. So what you can then do is at the 20-year or 25-year period, you could flip it to a repayment mortgage and then start paying it down over time if you wanted. Or you can just carry on forever. Because what we do as property investors is when it's worth 100 grand, that's great. In 10 years later, when it's worth 200 grand, we actually refinance up to 200 grand, release some of that money out, and that's what we use to invest in more properties. You see, you can't save for deposits, but your asset, the capital appreciation, is going to be there. That's going to allow you to take that money out and use that for future assets. And that's how I built a multi-million pound property portfolio, is because the capital appreciation has gone up. I've released equity and bought more properties from that. So that's a really, really smart thing to do. So your options are flip it over to a repayment mortgage. That's fine. Or just keep it the 100 grand if you don't want to take out more equity, because you like just having a tiny little payment. And think about it, rents by the time it gets to this 25-year period are going to be substantially higher, but your mortgage payments aren't. So you're going to make even more cash flow from this property, which is incredible. So let's just say, for argument's sake, that you carry it on, then you just put it on another interest-only mortgage. You just get a new lender, you do it for 25 years again, and that's how it goes. And here's the thing, with this property, the residential property, this goes off your income. And so I've got some friends that have had incomes impacted by the pandemic, right? And so they want to buy new houses. Their income's back, but because their tax returns, it hasn't finished the end of the year, officially, they're not earning enough to be able to buy a decent residential property. But buy-to-lets, it goes more on not your income, but it's more worried about the profit that you're going to make each and every month on the asset. That's the way they look at it. It's a very, very different way of thinking of things. And I think it's really important that you understand interest only is not risky. You need to manage yourself, but the bank's going to do this for you, right? So a bank is going to check all of the stress testing for you before they even lend you the money. And so over time, we release equity as this goes up. And so what's actually happening is inflation is paying it off. So 100 grand today is a lot of money. But I tell you something, when you get that 100 grand in 20, 30, 40 years, it won't feel so much. It might even feel like a couple of months' salary. I remember in 1999, I got my first property. I used a £3,000 deposit, and I thought that was a huge amount of money. It felt like so unachievable to actually get that much money. I just couldn't believe that I could afford to get this property. But now, £3,000 is an amount that you could just get a credit card or a loan, pay it off, and then everything is hunky-dory. But let me know, what do you think about interest only? Is it a vehicle you've used to invest? I think it's a great way to leverage your money and get really successful in buy-to-let. Give me a quick like on the video. Check out all the other content on my channel. And if you want to know how to buy a house for £1, I've got a video on that right here.